For me, it's just given a little bit of the background, so I might disappoint one or the other saying that I will not tell a lot about details about the markets. It's more about that general challenges actually we have when we look out on the real estate landscape, and I think actually that is an influence for all the markets we are operating in, and there is no real market story despite the general development we have. I try to outline here. I think one of the main challenges, and that we should keep in mind whatever we are talking about, that say there is a return to some kind of growth right now. Yes, it is. But still, if you look at unemployment rates in many countries, they are still on very high levels, north of 10%, in some countries still north of 20%. So there is an argument for Spain, but it's still 20+ unemployment rate, so there's not a general argument about Spain. And these are the things I think we have to keep in mind. And I think unemployment is not only the big challenge, it's also one of the drivers that going forward has to be solved, because that's also where the demand side in the medium and long run comes for the office sector. That influences purchasing power and therefore the retail sector. It influences tenure selection on the residential market. So I think that is one of the challenges we have to watch and have to look at. On the other hand, if you talk to anybody in the industry, urbanization is the story everybody is telling you about. And I think that's true in the sense that the people are concentrating ever more, but you have to keep one thing in mind. And coming from Germany, we have to deal with it for a couple of years already. It's not only about growing cities. Urbanization is not only about growing cities. We also have declining cities. In Germany, we have cities declining and growing next to each other. So urbanization also means you have to look very carefully at where you really invest in. And I think the declining city issue will become an issue in some more countries as we go forward. It might not be in the next 5 years, but in 10 years' time we will see that there are cities that are winners in the sense that they will continue to grow and others will stagnate or possibly decline. And if you're an investor with a horizon of 10 to 15 years, that's the exit time of your investment, and that's where you really have to understand what's going on. And I think it's not only about investing in cities, it's about investing in at least stable or growing cities. And that actually everybody wants to do, and that's where the challenge then comes by, because from the investor side, everybody wants to go for real estate. That's a little bit of an indication. What you see up here is actual allocation versus target allocation, and you see actually the target allocation is rising for the last years, no matter which region you're looking at, and it's not, and the actual allocation cannot keep up with this because simply there's a lack of product. Everybody might tell you that the investors are going up the risk curve. I don't think they are. They are simply going up the return curve because they need the higher return side and not the higher risk side on this point. And therefore they might accept value add, but they still actually would more love to have the core risk profile on it, but they simply need the value add returns, because some value add returns today have been core returns 6-8 years ago. So this is a little bit of the main story behind that. And therefore, I think also from this side, the concentration on properties is quite similar, what most investors look for. And given this, you also see this inflation of development to core, build to core, position to core, whatever. And that's simply the reflection that the investors want core investments. But you have to keep one thing in mind: the core or prime market is not expanding that much. So a lot of what is now labeled something to core will not be core in the long run, because simply the prime market is not expanding that rapidly as that might suggest. So it's very much coming down that you understand what you're buying into, and you have to be very careful what actually not only is the label, but what's the real product about it. And the other thing that's the challenging part for most investors, that now that's prime yields across the Eurozone office markets, and they're on an all-time low in most markets. The exception might be the Italian ones in Rotterdam. But looking at Italy, it might be an argument for why this is the case. In Rotterdam, also looking at the Dutch office market for the last years, there's also quite a good argument. But in all other markets, we are at record lows. And a lot of people are wondering, why will this, let's say, reverse? Why will yields start rising again? But implicitly, there's a strong assumption behind that. That's something like we live in a mean reverting world, so that actually there is a stable equilibrium that is above the current level that the market will return to. And looking at, let's say I've pictured overnight rates, then they start in the mid-1980s. Sorry, you cannot see the years down there, but they start in the mid-1980s. And this does not look like a mean reverting world if you look at the overnight rate. So if the interest rate environment is not mean reverting, why do we assume that yields will be? So I think that is one of the challenges going forward. Yes, we have record low prime yields on the markets, but we also have an interest rate environment that tells us the world might be not mean reverting. So possibly yields will go down further, especially at the prime end, and we will have to accept it. So, and one of the reasons why this can happen, you see up here, because the QE decision by the European Central Bank earlier this year was one of the steps going forward, but actually it's not that much liquidity they're putting in the market. Because when you look up here, you see, yes, they're QE, but they are simply bringing the balance sheet back on a level they had shortly after the financial crisis. While the Fed and the Bank of England, they remained on a high level. The policy of the ECB wasn't that expansionary in the last 2.5 years. So they're simply returning to a level we have seen already, and that's, yes, it's expansionary, but it's not that much expansionary as a lot of people might expect the QE decision of the ECB will be. And that's also one of the points why I believe that QE will stay longer than the end of 2016, because the structural issues of the Eurozone are still not solved. No matter what's happening to Greece, there are some other issues in the Eurozone that still are not solved, and I think that is one of the reasons why we can assume that interest rates will stay much longer lower than we would like to have that going forward. So that's more or less the great hope we have on the ECB. We throw out the money and hope it will work in one or the other way. And we will see in the coming years if this materializes. The other thing, and that's something possibly that also holds for real estate, for the prime real estate market, that's the government bond market. And the government bond market has a liquidity issue, because the depth of the market is not as large as it has been 5-6 years ago. Given all the QE activities of the central banks, a lot of the government bonds now are in the balance sheet of the central banks. So a lot of the trading volume, that's down here on the right side, it's a picture I took from an article in the FT from last week actually. Then you see that in US treasuries there's a trading volume drop between 2006 and today of around 70%. And yes, government bonds are liquid market, but it's not as deep as it has been in the past. And this is something that also holds for prime property. If you look at the prime end of the market, there are a lot of investors, or long-term investors like sovereign wealth funds or possibly German institutional money that's not in there for 5 years, it's in there for 10, 15 years or even longer. So if you look at the prime market and the price movements in the prime market, it's an ever smaller part that's actually really traded. And therefore price swings like the one we've seen on the bond side in the last 2 months, they're much more likely because the market depth declined heavily in the last years. And that is, I think, one of the points going forward. We will have to live with liquidity, with volatility, given the low liquidity or the lower liquidity we have in these markets. And talking to someone about government bonds, nobody will ever think of a liquidity problem in these markets. But I think depending on the transaction you want to do, that's the same as in prime properties, there might be the challenge to really get the deal going because there's not so much going on. And the other end, that's a little bit of the part why everybody looks at real estate. That's the bond yield gap. I looked now here for retail. I've pictured in actually the Q3 2014 numbers as a dot, because given that the bond yields came up so heavily, I thought that might be a better indication than just looking at the first quarter figures. So there you see actually also we are at an all-time high in this gap. And the same holds also if you look at the office markets. And the funny thing out of this is, looking at prime assets, is there really such a situation that demands such a high risk premium? If you have a well-let prime office property in the center of Paris, how much risk premium should you have compared to a French government bond? It should definitely not be at an all-time high in the current environment. So yes, there is a liquidity premium you have to pencil in. But I think everybody going for real estate accepts that real estate is an illiquid asset. So there's a liquidity premium for it, but it has not been that much. On the other hand, there is some other issues associated with it, but it's definitely not in the case that you have a risk premium that is 200 basis points at more or less the highest you had in history in the Paris CBD market. So I think that's also the point why going forward we will see prime yields compressing in all European markets, making it much more challenging for a lot of the investors really achieve their returns, their required returns. And a lot of people will try to move to these kind of develop to core, manage to core, build to core. And therefore I would say be aware of what actually you're buying into. Because funnily enough, if you look at the office markets in a little more detail, that what we've done here is, at least till the millennium, we had a quite strong relationship between vacancy rate, the lag vacancy rate and the prime rent. So as every time vacancy rates went up, prime rents went down, or the reverse. Vacancy rates went down, prime rents went up. But since the financial crisis, what you see here with in green, this relationship simply has broken down to a large extent. So it's not a market that we have classically known that there is vacancy rates go down, prime rents go up. We see prime rents going up and with vacancies rates staying high, or we see prime rents rising and vacancies rising in some markets even. So that's the situation that it's not like the typical textbook assumption you would have. So that's also one of the points. Look in detail what you're buying into. There's not a general market story out in Europe. There might be some story saying, yes, we have catch-up of some PIGS countries like Ireland. But personally, I would say the Irish story is told more or less, because there's not so much real, the pricing adjusted quite heavily in the last 18 to 24 months, so most of the Irish story is now over again. And Spain, as I mentioned, be careful what you're buying into. 20+ unemployment rate is still an argument for saying the country is not in recovery right now. And the other thing is look at the office markets, for instance, you see very low development levels. That is also a point going forward actually. We have 10+ vacancy rate, development is actually an all-time low when you look at the overall markets. That has also to do with institutional changes in the banking sector, because banks are less willing to do financing, speculative finance. That changed a little bit in the last 4 or 6 months, but I still think banks are very reluctant to go for speculative development side. So that gives you a little bit room for rental growth in a lot of these markets going forward. But as the economy is not really seeing a tremendous growth or tremendous recovery, these rental growth will heavily depend on location and quality of the asset. It's not so much about general market development. On the other hand, given the low interest rate environment, what people also looking back again very heavily is resi. Because compared to government bonds, resi offers a quite attractive yield spread right now. You have a lot of government activities trying to promote rental markets, like in the UK. You had it in the Dutch market where the government tried to restructure. Funnily enough, in Germany we go the opposite way, we try to regulate more. But all markets try to solve the same problem, that we have a housing shortage in the major urban agglomerations. So we will see if more regulation is the solution to build more housing, or less regulation is the solution to build more housing. For an economist, it's a real-world experiment looking at Germany and the Netherlands and trying to see which of these countries going forward will actually be the market best positioned. And on the other hand, what a lot of investors going when they look at resi, traditionally resi was a buy and hold core strategy. That was all the people were doing. Right now you see, and also not only from German investors who love resi historically, but also from international players from Asia or the US, that they look for value-add opportunities like repositioning of building, doing break-up sales, trying to increase returns out of really active managing strategies in residential, something we haven't seen in the past of any big investors going forward. So I think that's also one of the opportunities right now in the current environment. You really can go pan-European, because a lot of markets offer opportunities, but overall, I would say be careful what you're buying into, because that's very good advice from the research side, how to diversify your portfolio. So, thank you very much.